definitely a heavier economic calendar this week. And this Thursday, we've got an ECB rate decision with a 25 basis point cut widely expected. So begs the question, will this rate cut, as forecasted, finally take down euro dollar? Because as you just called out, euro retaining a lot of strength here against this dollar market.
It's an interesting market for euro dollar. It has been for the last 3-4 years, almost nonstop. But where we find ourselves going into what is supposed to be, the market is indicating, could be yet another ECB rate cut, is in an unusually strong euro market for the last 3 years.
100%.
114 is right around the highs that we've seen going back to, at this point, there's really kind of the pre-pandemic environment and then the post-pandemic environment for a lot of these forex pairs. And of course, if you want an example of that, take a look at dollar yen. Euro dollar, similar, that it hasn't been able to really sustain activity back above 113, 114, 115 since the post-pandemic economic boom that we saw, rise in inflation, rise in interest rates across the globe, but U.S. really leading the way, a lot of U.S. dollar strength on the back of it. You know the story. And you would think, okay, well, if the U.S. dollar got all this strength on higher rates, and we've been talking rates the last couple of years, then how is this euro hanging in around 114 when the ECB has been cutting more aggressively than the U.S., and another cut is due to come? And it's because the context matters, Glenn. And we're in an environment right now where interest rates are not the number one thing. It's an important thing, but until the geopolitical risk in Europe subsides or ratchets up again, whatever's going to happen, as well as the trade wars that are going on between the U.S. and almost everybody, those calm down or ratchet up again, the interest rate story is kind of a second or third tier story at this point.
I agree. You beat me to the punch on a couple things here.
Sorry.
That's all right. You know all things. It's very impressive. Just one headline and you knock it out of the park. But just checking in on what we've gotten already. Early this morning, we got an inflation statistic. May inflation coming in for the euro area softer than expected at 1.9%. They were expecting 2%, so not the biggest miss hit. We just covered what that euro market looks like. Not a gigantic leg lower, but some momentum already this morning.
Still good
off of this. Off of this inflation number.
Still good for and all of that being said, the trade war talk has been, if something comes out, that can be, 70, 80, 100 points plus in this euro dollar market. If we saw plenty of the stuff around not only the geopolitical risk maybe subsiding in the last couple of months between Ukraine and Russia, but also the euro area ratcheting up its development of defense, and that both those stories coinciding for many 100, 200 point moves in the euro dollar market. I appreciate that you bring this up because this number coming out softer than expected has correlated with this morning about a 50-point sell-off in euro dollar. So again, it's not that inflation and interest rates don't matter for this market at all. It's just like I say, the context, it really matters. When inflation and interest rates were the only story, go back to, you can see right here, that would have been 2022 and the start of 2023. No one cared about employment data, or some of these other things that they just fall by the wayside. This stuff still important, but just not as big of a mover as some of the other stuff currently on the table.
I agree, but this will definitely factor into the commentary later this week with the ECB
100%.
Because I think with this trade backdrop, a lot of expectations around it'll trickle into inflation. This is where it'll really hurt a lot of markets, and so for the time being, at least not any EU-US trade tensions not playing through into these inflation statistics thus far. But what do we have coming for us from the ECB? They're set to cut rates for the 8th time in this cutting cycle. Their key deposit rate.
Little cuts.
Death by 8 cuts.
Holy smokes!
Yeah, they're
8 times you guys had to meet to get from 4% to 2.5%.
Slow and steady wins the race, my
I guess
friend.
so. Yeah.
Now they're at 2%, and while this move is largely priced in, I think a lot of the expectation will be around. There's only one more rate cut predicted for the euro area this year. So
the market thinks the bottom is in.
Correct. Cutting now,
euro
pausing
rates.
one more, and that more or less aligns with kind of where the U.S. is, with only 2 interest rate cuts expected for the rest of this year. So what this does, you nailed it earlier. Rate differential is not really a factor thus far. But my 2 questions for you.
We've not taking questions.
Is it kind of, is there a nominal aspect to it? Like, when interest rates are, when the differential is less than 2%, there's no real carry trade opportunity there. When we do start to get more than 2%, do you see that play into, these markets, as we've seen kind of with that dollar franc in certain times, and definitely in that dollar yen? Does the actual nominal amount of the differential start to matter? Or, like you called out earlier, does it just have to be a low volatility environment for this to be a headline driver? Because there are so many other pieces at play right now in terms of geopolitics and
I think
trade tensions.
If it's going to be one, it's definitely the latter. I don't think that there is a lot of people will look at like real interest rates, for example, and be like, oh, if real interest rates get like above 1% or like into negative territory, then like the central bank has to act at that point. I don't think that's the case here. And honestly, I would take your dollar franc example to say that like that band has been expanding. The difference between Swiss rates and U.S. rates has been expanding now to, I believe, 2%, maybe 2% plus. And the dollar franc is at a rounding error from decade lows against the franc. And so it's not even like able to, we got out to 2% U.S. rates on top of Swiss rates. And so now we're going to come back from those lows, or like a lot of it, I think, is just there's so much risk in the U.S. economy. And I don't even know if it's necessarily risk, or a lot of people would say Trump has wanted a weaker dollar. It's part of his stance that he ran on, and he is committed to weakening that U.S. dollar. And until, I don't know if you want to call it fear or volatility, or that story kind of comes to an end, the interest rate piece is, in my mind, only going to be good for 50 point, 100 point, whatever type of moves, until, like I say, that this could get to another level where the trade talks and the Trump dollar weakening and everything takes us to like, now we're trading 115 to 118, that kind of territory. Or the alternative to that is all of that risk kind of comes out. Trump and his, his turmoil with Powell and turmoil with different countries over trade, that gets alleviated. And then I think you might see this euro dollar market move back down to that 105 to 110 range. And then you really see the differential between interest rates being the main factor. But as long as we have that headline story that has not been resolved since it got on the table in February, it's hard for me to say like, if the euro area even gets down to 1% for some reason this year, and the Fed here in the U.S. stays 4% bid, I don't know if that takes this euro dollar market down to 110 or 108 or 105.
It does feel like it's more on the dollar side,
for sure,
in terms of flight from U.S. assets as a
the
whole.
pound is 135. The dollar yen is at its lows around 140. Like until that U.S. story comes off the table, this piece is, in my mind, maybe only going to be good for 50 or 100 point one-off moves that
Not
just
a recalibration.
might
of this.
slightly recalibrate where the next big move comes from the trade talks.
Well, there you have it. A lot to consider. This European Central Bank meeting maybe not as heavily weighted as those prior.